Investors paying 1% in annual management fees lose approximately one-third of their total wealth to costs over a 40-year career. 90% of active fund managers fail to outperform a simple broad market index over any 15-year period after accounting for taxes and fees. You do not need a complex portfolio of dozens of stocks to build massive wealth. 3 specific exchange-traded funds provide total global coverage. Academic research confirms that asset allocation explains more than 90% of the variation in portfolio returns over time, rather than individual stock picking. The first essential holding is a physical replication exchange-traded fund tracking the developed world equity market, covering thousands of large companies. A standard developed world index includes approximately 1,500 companies across 23 countries, providing instant diversification across all major industrial sectors. These funds use market capitalization weighting, meaning you automatically own more of the most successful and valuable companies in the global economy. Index funds are self-cleaning. Failing companies shrink and drop out, while rising stars grow to occupy a larger percentage of your holdings automatically. Modern world index funds often feature total expense ratios as low as 0.07%, ensuring almost all growth stays in your pocket. The second fund focuses on emerging markets, including rapid growth economies like China, India, and Brazil, which are often excluded from standard world indices. Emerging markets represent the majority of the world population and a growing share of global gross domestic product, providing higher long-term growth potential. While these markets carry higher political and currency risks, they offer diversification benefits because they do not always move in perfect lockstep with developed nations. A common strategy is to allocate approximately 10 to 15% of your total equity portion to emerging markets to match global market weights. The third essential fund is a high-quality global government bond index fund, which acts as the defensive anchor for your entire investment portfolio. High-quality government bonds often increase in value when stock markets crash, providing a critical buffer that prevents emotional selling during a downturn. For the bond portion, it is vital to use a currency-hedged fund to eliminate the volatility of foreign exchange rates in your defensive holdings.
Bonds provide regular interest payments and a contractual return of capital, making them the primary tool for reducing the overall standard deviation of returns. By combining these 3 funds, you own a piece of almost every profitable enterprise on Earth, along with the safety of sovereign debt obligations. Your personal ratio of stocks to bonds should depend on your age and your ability to remain calm when the market value fluctuates significantly. A traditional 60% stock and 40% bond allocation has historically provided solid growth with significantly lower drawdowns than a pure equity portfolio. Younger investors with decades of earning potential might choose an 80% stock and 20% bond mix to maximize long-term compounding power. Rebalancing once per year forces you to sell what has become expensive and buy what is relatively cheap, maintaining your target risk level automatically. When stocks fall, your bond portion becomes a larger percentage of your wealth. Rebalancing then requires selling bonds to buy stocks at discounted prices. Complexity is the enemy of execution. A 3-fund portfolio is easy to track and manage, making it more likely you will stick to the plan.
Because these funds rarely trade securities, they generate fewer capital gains distributions, resulting in superior tax efficiency compared to actively managed mutual funds. Reinvesting dividends back into your 3 funds creates a compounding snowball effect that accelerates wealth accumulation significantly over 20 to 30 years. Major exchange-traded funds offer deep liquidity, allowing you to sell your holdings and access your cash within seconds during normal market trading hours. Many investors lose money chasing trendy sectors like technology or clean energy. These 3 broad funds already include the winners of every future trend. By owning the total world index, you own the companies with the strongest competitive advantages and the largest research and development budgets in existence. Equities represent ownership in real businesses that can raise prices as inflation increases, making your 3-fund portfolio a natural hedge against rising costs.
Bonds with intermediate durations provide a balance between yield and sensitivity to interest rate changes, ensuring your defensive anchor remains stable during policy shifts. The three-fund portfolio does not bet on which country will win the next century. It simply bets that global productivity will continue to increase.
The greatest threat to your wealth is not market volatility, but your own behavior. Success requires the discipline to stay invested through every economic cycle. Waiting just 5 years to start investing can reduce your final retirement corpus by hundreds of thousands of dollars due to lost compounding time. Automating monthly contributions into these three funds removes the stress of market timing and ensures you buy more shares when prices are low. During retirement, a diversified three-fund portfolio supports a safe withdrawal rate of approximately 4%, providing a sustainable income stream for life. Ignore the noise of daily financial news. Your only goal is the highest total return after inflation and taxes over a multi-decade time horizon. Exchange-traded funds offer full daily transparency of their holdings, so you always know exactly which companies and bonds you own at any moment. When you eventually need to liquidate your assets, the high trading volume of these broad funds ensures you can sell quickly without high transaction costs. To begin, simply select a reputable low-cost provider for a world stock fund, an emerging markets fund, and a global government bond fund.
Investing $500 monthly into this strategy over 40 years can result in a portfolio worth over 1.5 million inflation-adjusted dollars. Financial freedom does not require genius. It requires a simple, proven strategy, low costs, and the patience to let global capitalism work for you.